Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending Feb 5, 2021. I'm Preston Brent. Thanks for tuning in. Remember, don't be a rat brain trader. You want to be the red striped zebra. Stand out from the herd because the herd is almost always, at least 70% of the time, wrong. So you want to stand out. The best way to do that is be the red striped zebra. This week's theme is Mo Money. So let's kind of get into it. Let's see what's going on for this past week and then, what the charts are basically saying. So if we look at this and we just take a look at the weekly sound bites, let's just jump in with the index performance here, and let me just put up a little bit of a little notice here on just how the indexes are doing. As you can see for the week, everybody's in the green. Dow, S&P, Nasdaq, Russell, all in the green for the week. Strong week. It's the strongest week we've had since last November. Year to date, also everybody's in the green. Look at the Russell small cap index up dramatically, over 13%. And if we look at sector performance, there was not a top 10 sector that finished in the red this week. Energy being the strongest at 8.41%. Worse, communication sector, 0.81%. You can see the annual sector performance. Energy still leading the way at 8.81%. The consumer staples, it is down for the year 5.99%. You can see the PE ratio. The forward 12 month is still fairly high at 22.71. Dividend yield is at 1.5%, 10-year treasury 1.17. So the spread between the two is 0.33. We'll talk about that in just a minute. The current VIX is finished out the week at 20.87. Last week it was all the way up to 33, over 33.09 is where it closed the prior Friday. So we're down on the week about almost 50% for volatility, just kind of coming down pretty hard. We did see that the market kind of the previous week, as I said, it rebounded from steep losses. A lot of it helped by this fiscal stimulus and some some optimism on where the vaccine's coming out too. We also saw this social media coordinated short squeeze. It kind of abated this past week as well. We did see them try and squeeze some of the silver market, but it moved up, sending silver prices the highest level since 2013, but then it kind of quickly abated and pulled back down. Although I will show you the silver charts in a minute, I'm still favoring the bullish side of silver. And the Senate, the U.S. Senate here, which is what really helped goose the market towards the end of the week, they passed a budget resolution to move forward legislation authorizing a full 1.9 trillion in stimulus that wrong way Biden wants to put out there. So there's still a lot of froth in the market, guys. We got to be very careful. We've seen options market with over 44 million average daily contracts traded this year, which is up dramatically from last year and from the year before. So for those of you out there trading options for the first time, you must understand how to deploy option strategies, or I promise you, you will get burned. That's one of the hallmarks of our group since I've been running this thing since 2008, is just understanding the option market, and what is up sometimes can be down, and what can be down is sometimes up. You need to understand that. And when you have a lot of volume come in and it changes the skews, it changes volatility. And if you don't really know how to play in that world, then the odds are clearly against you. Okay. So the other thing is, if we look at the index performance for the week, you can see here that just coming through, we can see on the economic data, a lot of the week's economic data this week was mostly surprising to the upside. Right? ISM gauge of services sector has come in at the highest level, 58.7. And just as a note, anything above 50 is expansion. It was the highest level since February 2019. Okay. The expansion in the services sector has now matched the manufacturing sector. So we're getting strong with the opening of the economy, strong data coming out of the manufacturing side. We also saw weekly jobless claims. They fell more than expected and reached their lowest level, 779,000 since late last year in November on Friday. And then we got the Labor Department reported that employers added only about 49,000 jobs in January, but that was kind of in line with expectations. And that was following the previous month's downwardly revised decline of 227,000. Okay. Now, of course, if we look at U.S. Treasuries, the yield on the 10-year benchmark continuing to move higher, all right, propelled by the vaccine news, improving economic signals and stimulus hopes. They're also changing the way that they count what is and what is not COVID. It's just, to me, it's so goddamn silly that they're doing that, because it seems like with the new administration in there, they're trying to jury rig the numbers and change the status of how they count everything. So it's not going to be an apples to apples comparison. But either way, the way they're now counting it, we're going to see the COVID number of cases go down dramatically based on what they're including as or is not a COVID. Also, the extra yield over treasuries, which is kind of a inverse measure of the corporate bond market's sector appeal has tightened. So it does show that there's a lot of liquidity running around in the treasury market right now. The yield curve is up the most sharp since, in years. Low rates are also helping the mortgage and the housing markets, with a record over $4 trillion in home loans originated last year. And the feds are continuing to gobble up to the tune of $40 billion a month of mortgage-backed securities. All right. So one of the things we got to watch, though, is this rising interest rate. As you can see on there, the Treasury yield closed the week at 1.17%. The spread between the Treasury yield and the dividend yield of the S&P is only 33 basis points. As that spread tightens, you're going to see money, as interest rates move up, start to compete with equities for where money goes. And that yield curve is moving up dramatically. And once that happens, we're going to start to see a little bit more allocation into the treasury markets than normal. All right. Just as an FYI, about 70% of all stocks right now in the U.S. markets pay a dividend. That's higher than the U.S. 10-year treasury. But if the 10-year treasury rates continue to rise, that's going to cause a reallocation, as I said, of money from treasuries into equity. So we've got to keep a very sharp eye on the U.S. treasuries market. Okay. Now, of course, if we come over and we take a look at Europe, you can see over here on the screen in the world index all across Europe and in the Asian markets too, the FTSE, everything is in the green. I mean, it's really amazing. For the week, the FTSE, the CAC 40, DAX, the Nikkei, China, Hang Seng in the Asian markets all had a green week. Year to date, everybody's in the green. The leading the pack, of course, is the U.S.-based small cap Russell Index, up over 13%, as I said. Shares in Europe are all going up on hopes of a quicker economic recovery. Also on the pace of the vaccine distribution, which hopefully will improve across Europe because they've been horrible at it so far. And we're seeing a little bit better than expected Eurozone GDP numbers come in. But they're also raising the long-term inflation expectations, which is lifting the yields in European bonds as well. So we got to watch this very closely, folks. Right now, there's not an issue. And if we were to hear from Jerome Power Ranger Boom Boom Powell and Janet Aunt B Yellen, and she's got a bunch of blueberry pies in the oven because everybody in the markets want more money. They want that sugar. We're getting ready. It looks like the Dems are going to ram through a $1.9 trillion stimulus package. The markets near term are going to like it, but I think it's going to set the interest rate and inflation expectations up a good deal. So just watch and see how this thing plays itself out. Okay. But we're also seeing Europe is slowly, with the vaccines coming out, they're going to improve their vaccine distribution across Europe. So we'll see the number of daily COVID infections start to fall, right? The ECB also lowered its forecast for economic growth in 2021 to 5% from 7.25 because it's taken them longer to open the economy. But excuse me, they're also raising their estimate of 2022 GDP to 7.25%. Just huge bumps because the economies there as well as here in the U.S. really sucked. Okay. Let me take you over and show you some key charts. Just kind of what we're looking at here. I'm going to take you over to a 4-hour chart. of the E-mini S&P 500 futures. Let's go take a look at that for a second. So let's just let that come up on the screen. Excuse me. So what you can see now is on this E-mini, looking at this 240-minute chart, you can see the big move that we moved higher. Off these lows down here, just a huge move up. The fact that we made higher highs this past week, in fact, going into Friday, we made higher highs, right? Let me just, I'm going to get a drink of water here real quick, guys. Let me just mute my mic for a second. Sorry, guys, right back with you. I think I swallowed my coffee the wrong way. So basically, what you're seeing here is this huge move. We were actually back at the end of January. We hit lows of 36.56. We closed out at 38.84. Right, over 220 points higher in just the first week of February. Just a huge, strong week. You can see the dividing line between being in the red and being in the green for the year. You can see the all-time highs made this past week, the 2021 lows that were made earlier in the year. We almost came down and touched it. You can see here the fact that we've made new all-time highs, that any move lower is going to be a dip. You can see all this volume over price right here. So I'm expecting a little bit of a pullback here. Remember what I have said. I've said that a 10 to 15% pullback is in the cards for Q1. Okay. I still believe that we're going to get a little bit of a pullback. I don't know what's going to precipitate the move, but let's just wait and see. But I just wanted to show you just the rapid movement that we've had here in these markets. Now, if I come over and let me just switch the screen, what I'm going to do is I'm going to show you the Fang Index that I've created. Let me just move that over here like this. And let's take you over here. So if you look at the Fang Index, you'll see, I'm going to wait for it to paint the screen here for you guys. Okay, so now looking at the Fang Index, you can see we're in this shaded zone up in the up here, but we actually made 2021 highs and all-time highs for this index. Now this index is comprised of Microsoft, Facebook, Apple, Netflix, Google, and Amazon, all the big guys. You can see we've been slower to move higher in the FANG stocks, but we've got a big contribution that really kicked off about the third week in January. You know, we had a retest, actually moved into the red for the year on the 29th of January, and then like all the other asset classes, we moved really up strong this last week. I just really very strong. Of course, if we look at Nasdaq, same thing with Nasdaq, right? All-time highs here, finishing it off on Friday with these all-time highs. And then the strongest of the two, if we look at the Russell futures, or the strongest U.S. index, all the way up here, right? I mean, closed near the highs. It's setting up for a divergence, a little bit of a pullback, but again, any move higher and any dip is probably going to be bought at this point in time. Okay, so we should just anticipate that. If we come over and we look at emerging markets, you can see emerging markets, and I'm just going to move this up. I need to change it to 2021. But emerging markets are also moving up very strong as well. And that should be expected with very low interest rates, with the dollar having come down very hard. We got to watch the dollar very closely. And then, of course, if we look at volatility, you can see VIX this in that hard down week. You know, the VIX actually moved up. The end of January, we had a high print on the VIX of 37.51, and we closed this week at 20.87, 17 points almost to the downside in 1 week, just about. It was really amazing move this past week. in the US markets, and volatility has shown that. But I want to show you guys something. Vol has been over 20 for a very long period of time. You can see our black swan territory here. Then we have the red zone, kind of a rose colored yellow, and then green light down here below 15. This is the longest that it's been above 20 going back several decades. All right. We may set records, and the markets are perplexed as to why volatility is still above 20. If we were to come out to the April-May term structure, all right, you can see the April-May term structure just moved into the green. It had been in the red up until this Thursday, and then moved back into the green, going all the way out to April, May, a backwardation which shows fear out in time of the markets. The markets are still fearful of what's going on, and I don't think money is trying to figure all this stuff out and just where everything is. If we look at the near term structure, we're in the green here too, but we're still elevated. That tells me that the markets are still fearful at this point in time, just barely being in the green. So we've got to be in a very cautionary mode, right? If we look at the bond market, look at the degradation here in bonds. As you guys have heard me say over and over again, once we got below the 50 EMA, any movement over, you need to be shorting the bond market, right? Or buying puts in TLT, either one. And it's just been a really good trade, all right? Now, if we look at this move here, we've made a low and a lower low. The MACD, if we get a little bit of a move higher, setting up for a bullish divergence, which would probably move the bond market back up to the 50 EMA. But again, like all these other times, the odds would favor selling off on bonds if they do pass that stimulus bill. 1.9 trillion or close to it. Bonds are going to continue to go lower. Okay. Now, if we step it out and you ask, well, where can bonds go? Right. Bonds can come down to the 2020 low price. This was made back or in 2019, 2020 at the very beginning, all the way down to 155. So we've still got a ways to go, right, to hit this consolidation point here. And then down around the 2018 closing price in the mid 140s. So we're still somewhat elevated, right, in the bond market, but we can go lower. So what does that mean for interest rates? Well, that means interest rates can go higher. If we look at where interest rates were back at the beginning of 2019, the 10-year was at 2.84%. And then with all this money coming into the market, the 10-year came all the way down to 39 basis points. And now we're slowly working our way back up again. And keep in mind, folks, as that yield curve steepens, and as this 10-year moves up, we got these little stepping stones along the way. It's going to start drawing money out of the equity market back into treasuries. That means big money is going to start reducing their equity allocation and increasing their allocation in the treasury market or the bond market. And that is going to have an effect on equities, right? Deleterious. It's going to move equity markets flat to down. It's going to have a harder time to play that game. Now, also, if we come down here, and for our members, there have been a number of different ways that I've offered up trading this. It's been a really good trade for members that have been following along. If you're not a member of our group, I highly encourage you to come in and check us out, right? It's a lot of fun. We're doing really well with these markets. If we look at the US dollar, though, all right, look at the dollar on this weekly chart. You can see where, well, let's put it back on the daily first. You can see on this daily chart, just like the bond market, we've been bearish the dollar. Any move above the 50 EMA, which is that run line, you want to be a seller, not a buyer. Now notice we've moved back above the 50 EMA after hitting a 2020 low back here on the 6th of January. And the dollar has been spending most of January and some of February moving higher. We've regained the 50 EMA, but we've hit this colored bar, which is a big resistance point. You can see we moved one bar above, and now we're sitting right at the bottom of it. I want to watch very closely to see if the 50 EMA can hold. All right. Remember, this is part of our low-hanging fruit trade that I was offering up to you guys for free in September, October timeframe. If you had taken it like a lot of our members did, you would have made a killing in the currency market, or you could just trade the ETF, right? So the best way to make that trade, as I pointed out, was in euro, right? Over in this area right here, euro is just, it was just a low-hanging fruit trade. If we put it on a weekly chart, been bullish the euro. I mean, look at this. It's crazy. Currencies have a tendency to trend. Now with this beautiful bearish divergence that we call a bed, that means we're going to get this pullback. It's probably going to pull back and settle in down here, and then it's going to make another run. I've got a longer term projection of the euro up around 126, 127. My original trajectory was around 120 when it was back over here. All right, and certainly clearly back over here around 114, 115. I said, let's ride it up here. It extended above, and now it's going to kind of find some support resistance in this zone here. All right, this was another one of our low-hanging fruit trades that many of our members took. And there are different ways to trade it in the ETF market that I go over with everybody. Now, one thing I wanted to show you that we want to watch very closely. This is DBC, Delta Bravo Charlie. This is the commodity index, and it tracks all commodities. Now, if you look at that chart, anybody, even a first grader, would know this thing has been moving left to right, up from the lower left-hand corner to the upper right-hand corner of the screen. This tracks a basket of commodities getting stronger and stronger, which also means inflationary. If I were to put this on a, well, let's just zoom out. I'll leave it on a daily, and let's just back out here. You can see this trend line. Now, this goes back to 2018, but let's just take it back to show you where commodities have come from, okay? You can see this big move. Actually, I could have extended the line all the way up here, and this was back in 2011, right? And if I go back even further, you can just see right here leading up to the 07-08 crash. So the point of this chart is going up into, this is very inflationary with commodity, the DBX moving up like this, and then we had the crash, right? And then with all the money that was printed that came out of the 08-09 financial crisis, it's just been very deflationary for commodities, for interest rates, just going lower and lower. And now we're just now breaking that trend line, moving up. The next resistance point is going to be here. So from a long-term perspective, if inflation starts to come in, which I believe it will, we've been in this deflationary kind of thing for quite some time. Same thing with commodities. Over the next decade, I would say if you can refi your mortgage or get a mortgage, refinance it, do all that stuff, that would be a way to go, because we're going to see inflation start to come back in again. All right, it's rare that we've got a market where they're pumping so much money into it with interest rates so low, with markets at all-time highs. The markets are upside down, guys. So are we going to get a bear market? Heck yeah. You can't pick the top, you can't pick the bottom. I do believe we're going to get the mother of all bear markets in sometime in the next 1 to 3 years. It's hard to pick. I mean, if you go back to the year 2000, people were calling for a bear market in 97, 98. And if you remember, Greenspan came out with the term irrational exuberance. He came out of that in middle of 97, and it took almost another 3 years before the markets cratered. So this is why I believe 2021 could be a strong year from a bullish standpoint. But I do believe we're going to get that bear market, and we're going to be set up very nicely. When I founded our user group back in September, the markets were in the middle of a free fall, and we made some great money in 2008 and 2009. And then as the markets reversed course, so did we, and we continued on. So this is kind of what I'm seeing here, is just kind of a heads up. And let's just look here. If we look at energy, let's look at the oil markets. The oil markets are off these lows, right? Oil is a big leading indicator of potential inflationary kinds of thing. And as you can see here, oil has just been holding my support line and then moving higher really since November of last year. And we're up in some shaded zones up here that show more overhead resistance, okay? But oil is basically moving higher. There are no divergences on here so far. So oil is an inflationary thing, okay? And supported by wrong way Biden's administration cutting the pipeline, which is the biggest dumbass thing I've ever seen. Let's put more greenhouse gases in the air by reducing or cutting the transport of oil underground, which is very safe, to above ground, which is less safe, in trains controlled by Buffett. Obviously, he had something to do with that, right? And transportation above ground, because Buffett was a big donor. So again, it's just makes no sense other than political sense to make that cut. But the right thing to do. Obviously, politicians don't do that. So anyway, we want to make money on it. So we're seeing oil up. I've already talked about doing unbalanced condors, not iron condors, but unbalanced condors in the oil market. It's a great way to go. Okay. If we look at nat gas here, even with all that cold weather, nat gas has moved up, but I think any move higher in nat gas is one of those situations where it's going to be hard to hold. I'd rather be a seller of nat gas than a buyer. Now, speaking of rising inflationary tendencies, if we look at soybeans, I mean, look at the soybean chart, right? Straight up. I mean, it's just unbelievable, caught on fire. Let's look at corn. Corn, straight up. Again, these are markets that we follow, that we've made trades in, that are pretty good, all right? Are actually outstanding. Look at wheat, again, higher. So the ag market has been very strong, and DBA kind of follows the ag market in general. It's just an ETF if you don't want to trade the futures. Also very high. Let's look at meats. If we look at lean hogs, going higher, all right? Let's look at cattle futures going higher. So we're getting cattle and hogs, meat prices going up. We're getting the ag market prices going up. We're getting the energy market, commodity prices going up. So, folks, that is going to find its way to the kitchen table or to your gas tank with higher prices. And higher prices basically translate into more inflationary tendencies. And that's going to make the bond market move up. 30-year, we're seeing that already. The yield curve is getting steeper and steeper. And there's going to come a point, as I said, where money is going to slowly drift from equities back into treasuries. And we're going to make these plays. You know, if you're not a member, I highly encourage you to come in. We're going to have a lot of fun here. If we come over here and let's just look at gold for a second. It cannot, even with a strong finish on Friday, cannot hold that trend line, all right? It did manage to get back up above the 200 EMA, this yellow line, and is finding support right around this area here, which is around 1780. Silver is, as I've been saying for the past couple of years, where you want to be in the precious metals market. You can see silver broke the same downsloping trend line. There was a attempted short squeeze. It came back down, but I do like silver longer term. Okay, there's some other things in the equity or in the metals market that we're playing that I think longer term are going to serve very well. One of them, Freeport-McMoRan, just a really great. You can see here any dip in Freeport-McMoRan, it came down and hit the 50 EMA, is a solid buy. I mean, you got to buy it. It's going to go higher. It's just a given. Okay. Oil markets, as I showed you before, you can see here, I mean, oil was $35 a barrel back on October the 30th, right? And then it started November like the Russell and just took off, right? So that is just a very strong sign that 2021 could be a good, strong year. Inflation's going to come in. It's going to scare the children. And I do believe it's going to cause a backwash in the markets. But our bear market, I don't see a bear market going forward in 2021. I do see a little bit of a 10 to 15% dip. You know, we may have a couple of 5% moves lower. We did have a 5% move lower in the month of January. All right, this past month. I was expecting a little bit more, but we didn't get it. Too much momentum, too much money chasing fewer stock shares outstanding. So that just moves equity markets up. But I do believe we're going to find it. All right, everybody, that's kind of where we're sitting now. Members, I will see you this Sunday evening for our weekly market watch. Have a really great weekend, everybody, and enjoy the Super Bowl. See you guys. Ciao.